Thanks for watching. Today is May 9th. I'm working more on my stock market tool. It's 11:30 p.m. where I am, but my plan is to go live with paper trading on Monday. So I've got to get down to business and get more stuff done. So before I get started today, I'm going to go over the goals for the project, what I've done so far, my progress from earlier today, and then I'll get into what I'm going to be doing on this stream. So my first goal is to beat the S&P 500 by a significant margin while staying market neutral. So the S&P goes up on average 6% per year. I want to do significantly better than that and return 18 to 24% per year. It should also be market neutral, so it should reliably give the returns whether we're in a bull market or a bear market. Now, my second goal I have for this is I'm writing all of this code in Python. And so basically, you need to have a robust code structure so that you can backtest your strategy. And so I'm open sourcing this and generalizing all of the code so it can work for any sort of model you want to create with the light gradient boosting method. And you have price data, sector data, information, all sorts of backtesting strategies, and all sorts of methods for assessing the model. So if you're interested in that, you can build the same thing that I'm building if you start from scratch and do your research. So check out the GitHub link in the description. If you find it useful, please star the repository, watch the repository, and follow me on GitHub. Also, I would appreciate it if you let me know how I could improve this tool. So the first step for this strategy is to define a stock universe. So you don't want to train the model on everything. Different assets move differently. For instance, ETFs move differently from common stocks. So you want to isolate a stock universe. Now I've done that and I've used it to train a model, which does pretty well. So for the model, you create features and you create a target. The target should be, it uses the features to train to predict the target. And so the features need to be useful, and the target needs to be something like return for the day, probability of a positive return, return for the next 5 days, return neutralized to market, neutralized to sector. I'm actually using the Sharpe ratio. That's what I've had the best success with. So I've got a really good returns model. I'll go over that in a second. And so once you have a good returns model, the final step is to implement a portfolio strategy for that. So you need some way to take the output of the returns model and choose how to allocate your capital. Now, here's the model I got about a month ago, and here's why I'm confident in it. So the first reason I'm confident is if you look at the red box, these are the metrics I'm looking at. So I'm beating every metric by a significant margin, other than the standard deviation of the information coefficient. My goal is 3 to 13 times the information coefficient. Here it's about 3 times the information coefficient, so it's down at the bottom end of my goal range, and the lower the better. So that's good, and all the other metrics, it's beating my goal by a significant margin. This first metric, information coefficient, is telling me about the predictive power of the model. The next 4 metrics are telling me about the stability of the model. So this model is for a single, this is a single model trained from 2011 through 2019, validated. Basically, I'm tuning the hyperparameters from 2019 through 2022. And then it's testing from the middle of 2023 through the beginning of 2026. So it looks really good on the metrics, so that's my first indicator that it's good. Secondly, I look at the decile analysis, so if you divide each prediction, if you get the distribution of the predictions and then cut it up into deciles, bin it into deciles. The bottom decile should be the worst performing. That's exactly what we see here. The top decile, top 90% and above, should be the best performing. And in between each decile should be higher than the previous decile. That's known as monotonically increasing. So it has all of these characteristics. So not only do the metrics look good, the decile analysis looks good. And then when I did a walk forward analysis by training a different model for each year from 2016 through 2025, it's still hitting my goals for all of the metrics on every year. And so these 3 things combined show that this is a really robust strategy. So the next step was to implement a portfolio strategy on this model. For the model that started in that's testing from 2023 through the beginning of 2026, it was really easy to get a good portfolio strategy. So almost anything I tried, I got really good positive returns. This was not the case for the walk forward model. So from 2016 to the end of 2021, it went negative. It had a slight recovery at the end of 2021, beginning of 2022, and then it basically flatlined at zero until mid 2023 when it took off, same as it did here. And this is about the same return. This one's actually giving slightly higher returns, but you see, basically, it's only performing well since the middle of 2023. Um, and so I'm not really confident in that because that means basically it did well for 2.5 years. I haven't tested it on 2026 so far. So this is kind of problematic, and I don't feel very confident in this. When I looked at the decile analysis of each model in the walk forward, I found that they aren't all perfectly monotonic, and the spread's changing quite a bit between them. So if you look at the spread in 2020, it's about 8% from minus 0.06 to positive 0.02. It's actually closer to 10%, but here it's going from minus zero point 0.2 to positive 0.15. So this is 35%. So three times the spread in 2021 as it was in 2020. And so those two things are changing. So I started looking at different portfolio strategies. On the basic portfolio strategy, it wasn't that performing that well. So I tried a couple of things. So the first thing was I improved the model. So if you look at this model here, so this is the same exact as the previous model, but I dropped out all of the features that had a coefficient of variation above 1 or a mean importance below 5%. And you see here, this actually looks a lot better. It looks a lot more monotonic. The spread, though, is about the same for the years, but visually the distributions look a lot better. And then if you look at the return when I'm implementing this simple portfolio strategy here, it actually does well from 2016 through the beginning of 2020, and it fails during COVID and then does well after that. So that's a lot better than my previous problem where it only did well since middle of 2023. Here I can basically say that this strategy is doing well over the whole time, but failing during COVID. So I basically need to get something that works well during COVID. And COVID, though, is pretty bad. Like you see the drawdown here at 30% drawdown. And the drawdown duration is what's really bad here, 550 days. That's, let's see, what's a year and a half? 180 plus 360, 440, 540. Yeah, so this is basically it went negative for a year and a half. And that would have been hard to keep implementing the strategy during that time. So I need something a little more robust, but this was a step in the right direction. And so I tried another model where I found earlier so now I'm training the model to predict the forward Sharpe ratio over the next 5 days. And I found earlier when I was using the return as my target, the log return, I found that if I added in mean reversion and volatility features that are neutralized to the sector, the model performed better. So that's what I added in here on the top model. And this actually looks better than the previous one that I just showed here. And so I decided to try out this model on a portfolio strategy. And the portfolio strategy looks better than the previous one I showed. So I decided to go ahead with this. You see it's not going negative. It never actually goes negative. I tried also the second model at the bottom where I did the same thing as before, where I dropped out all the features that had a coefficient of variation above 1 and a mean importance below 5%. But this actually looks significantly worse than the model above. So like look at 2022, for instance. The decile analysis looks close to perfectly monotonic here. You see basically the only problem is with the 30%, the third and fourth decile. The fourth decile is lower than the third, but other than that, it looks really good. Here in 2022, you see it's not monotonic really at all. It's has this flipping, low, high, low, high, low, nothing, high, So basically, I decided to go ahead with the top model as my model. So I looked more earlier this week at different portfolio strategies. What I have that's working well is a very basic strategy. This one here. I found that if I scale down based on volatility only and set the target volatility at 12%, so start to scale down the portfolio exposure if volatility falls below 12%. I got this really good strategy here, which stays fairly positive in 2020. It reached a high in 2020 of about 100% gains, and it dropped down to about 70% gains. So that's something that I could actually tolerate. That's not a crazy loss. And 2020 was really an exceptional time period in the market. I tried just leaving that 12% volatility scaler and changing around the scaling from the information coefficient. So the idea is if the information coefficient of the model is high, use full exposure. But if the information coefficient drops and over recent time the model is not useful at predicting, scale it down. And so I tried changing around the information coefficient scaling parameters, but you can see here these are really noisy and there wasn't really any clear trends here. So um, now, one thing I found out, kind of something important this morning, is that I was implementing the portfolio strategy wrong. So the model's trained to from open to the open over in 5 days from now. Um, and the portfolio strategy I was implementing from the close to the close. So I changed it to go from open to open, and this improved it actually substantially. Look at the drawdown chart. This looks a lot noisy, so it's drawing down, but then it comes way up. You could also see the magnitudes a lot lower of the drawdowns. Um, and especially at later times. Here it's drawing down under 10% in recent times. Here it's going up to like 15%. So the drawdowns are significantly lower in magnitude. But what's really exciting here is you see the drawdown duration. The best I was able to get was 297 days. So, basically 10 months. Um, but these are market days. So that's actually a full year in the market. But here the drawdown was only 164 days. So the drawdown period is a lot smaller. The maximum drawdown is a lot smaller. And this is with a very simple scaling strategy, only scaling down from the volatility. So I've decided this is the model I'm going to go forward with. Since there were different things that worked, I want to try out a bunch of different things. So I'm trying both this model and the model I showed above that works well. So I'm using this top model here, and then also the model right here. And then I'm implementing different portfolio strategies. So I'm going to optimize for 2016 using all scalars. Then I'm going to optimize. So that's one strategy. I'm going to use another strategy where I'm optimizing the portfolio strategy from 2016 through 2022. And the idea with that is that what's the idea with that? Oh, basically that I'll be able to. COVID is included in that training region, and then I have one strategy where I'm optimizing only for COVID. I'm going to use a couple of first principles strategies where I just use well-known values for the drawdown and volatility scalars. And then I'm going to try a strategy where I'm optimizing from 2016 up through the current day. And then for the models, I have these different models. So those two models I showed, but I'm going to try them trained up through the end of 2025, which is the same thing I'm doing in the walk forward. I'm going to try training it only to train to current, so including the beginning of 2026, training it on the past 3 months, and then training it up to current without any validation. So just using the hyperparameters that I got from the walk forward analysis. So that's what I'm working on now. My goal is to get all of these strategies and models. Each model should have a different strategy. So we're going to end up with 1, 2, 3, 4, 5, 6, 7, 8 times 1, 2, 3, 4, 5, 6. So I'm going to end up with 48 total strategies that I'm implementing for paper trading. And then I'll be able to monitor them, see how the performance is over time, and basically choose. Hopefully, at the end of paper trading, it will be obvious what's performing well and what's performing poorly. So What I'm working on now is implementing the model. Now I forgot where I was when I ended the last stream. So, oh right, so I'm getting this error. So I'm trying to figure out what is the source of this error. Um, yeah, so of course I work on this every day. I'm about to start paper trading. I'm going to paper trade for 4 weeks. If the strategies do well over paper trading, then I'm gonna pick the best one or a few of the best ones and go live and start trading real money. Um, and then yeah, over time I'm going to implement more strategies that aren't correlated to this strategy, and then keep improving this strategy. I have a lot of things I can do to improve this strategy, but it's a lot of coding. It'll take a long time, and since this seems like it's performing pretty well, I'm just going to start paper trading on it, and see if it does well live or not. So that's my goal. Now I'm getting this error, so I have to troubleshoot this error. So let's look at this. Why do I get this error? Okay, so oh yeah, I also have to say this isn't financial advice. This is academic exploration into stock market models. So don't take any of this as financial advice. It's all modeling, just a modeling project, data science project. Your test set isn't really 2026 1 1. Oh, there's a gap offset. So for your data, so your effective test start, yeah, okay, yeah. No, I already did that yesterday or 2 days ago. 2 days ago or yesterday, one of the two. Drop in A after target generation eats the recent tail. Right after generate targets and features, right after the filter. Train filtered single model. Okay. Um, right after the what? Filter. Okay, so I guess it's going to get everything first. So let's finish the names for these. Each model needs a unique name. 2016 to 2022, optimize all scalars. So 23 underscore 16 to 2022, 16 to 22 underscore, what is A? Oh, A for all scalars. Oh, but they're all being optimized to all scalars, so I can drop A. '25 underscore 2016, 25 underscore 16 to 22 underscore 2026, 25 underscore 16 to 22 underscore 2026, 16 to 22 underscore current, 16 to 22 underscore current, oh, so this needs to go after the data split. Train model, tune params, split data by dates. Okay, so we'll put it here. '25, 16 to 22 current. Oops. '23, 16 to 22 underscore 3M. 3M. And then these guys are underscore no val. All right, so 23 underscore FP1 underscore 2026. Copy that, put it here. 23 FP1 25 FP1 26. Copy those guys. So same thing, current model 23 trained on past 3 months. Okay, I'll just put those guys in. Change this to 3M. change all these guys to be FP2. Okay, so this is about to print out the the tests we just put in. Let me listen to some music. Let me know if you guys have any suggestions. Okay. All right, so let's see what it says. Test set empty. What line was that? 1042. In train single model, 1042. Test set empty for test start to test end. Oh. Okay. So this actually needs to go here. Hey, Soulwater. Oh, my brother says he's too busy to play in the chess league. He says he won't participate. He said he won't join the games. I saw him tonight. We watched the UFC. Does any of you guys like watching the UFC? It was a great fight. All-time fight. Sean Strickland became an all-time fighter tonight. And the co-main event was crazy too. I mean, it's not a universe problem. If the universe is stale, no. That can't be it. Let's look. Import pandas as PD. And df is equal to... So how many people do you got? How many teams do you want to have in the league? Read feather. And let's read /data/all ohlcv dot feather. df dot date, yeah, goes up till May 7th. Oh, moving the test start earlier. I guess I don't really have to see how the model does, because if I move the test start earlier, I'm going to lose data. Oh, I've never watched the WWE. UFC is like different. WWE is more like a live, almost like a play. I want you to watch a video regarding India and Pakistan. Pakistan, India and Pakistan. You guys are always fighting. 7 teams. That's pretty good. Um. Oh, the universe is stale. Oh, duh. Of course. I forgot I have to regenerate the universe. Alright, so if we go to Universe Explorer. Where is it? Universe Explorer. Get Universe 7. Let's turn that back on. Paper trading models. Nope. Universe Explorer. It was nice. What was nice? Well, tell me what the documentary is. Oh, it's a video. Tell me what the video is. Yeah, of course it's a universe problem. Alright, we're up to 2018, so it's done 7 years. It's about halfway through. So let me finish filling these out. FP2, 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 FP2. Okay, good. 2020 optimized all scalars. So 23 underscore 2020 underscore 2026. Same thing, 25. (2020) underscore current. Same thing here, underscore current. Underscore 3M. Under the propaganda. It's an analysis of what is the actual thing here, why the propaganda exists. Oh yeah, it sounds cool. Tell me what it is. 3M. Okay, Universe Explorer finished. Paper trading models. Okay, so let's put the same things here. Now here it will say no val. Okay, almost done. Optimize 2016 to current with all scalars. So 23 underscore 16 to current underscore 2026. You keep telling me about it, but you don't tell me what it's called. So this is 25, same thing. Here, underscore current. Yeah, well, tell me the overview. Give me the overview and then give me the name of the video. What is it, a YouTube video or a documentary? All right. So you've named the models. Let's see if this runs now. If this runs, then we'll be good on the first model and we could run through and get the different portfolio strategies. But I need to think about what portfolio strategies. Oh, I guess optimized to 2016, all I have to do is get the parameters and um, so let's think. I need some class for the strategy. So if I go to scripts, live strategy. Okay, so I have a capital allocator. So I could just make a different capital allocator. No, all I need is I'm implementing the HRP method for all. Oh, who deserves Kashmir? Foreigner learns the shocking truth of India and Pakistan conflict. Captain Raghu Raman. Raman. That's a famous Indian name, right? Like Raman spectroscopy. There's a great physicist named Raman. It says how the partition happened, what was going through Jinnah's head, and why Pakistan took the stance as anti-India, the Kashmir story, development, etc. I always heard it was like the basic analysis I always heard is like the Hindi-Muslim conflict. And yeah, Hindis don't like the Muslims, or they don't get along, basically. That's what I always hear. And Pakistan's Muslim, right? And India is mostly Hindi, but has a fair amount of Muslims. And then they also had, I guess, East Pakistan became Bangladesh. All right, what's it called? Who deserves Kashmir? Foreigner learns the shocking truth. Whoa, it has 1 million views. Oh my god, stop it. How did you save? Oh, good, okay. Watch later. Okay, we've got it. Yeah, CV Raman. Of course, dude. Physics. Yeah, Raman spectroscopy. He's a legend. And then there's another famous Indian mathematician. I mean, there's a lot of famous Indians. My boss is from Pakistan. Okay, did this guy finish? Oh, test set's empty. Man, same problem. The data goes up. Maybe the universe is... What's the universe defined through? Explorers, Universe Explorer. Get Universe 7. Oh yeah, so it's getting it through February 26th. So let's get it through May 7th, 2026. Srinivasa Raman. That Hindu Muslim thing is also a propaganda. What is the propaganda? Bose, yeah, that's right. Bose proved plants have life. All I know is Bose from the Bose-Einstein equations. Known for Bose-Einstein. Yeah, this is all the stuff that I know. Oh, wait, is the boson is named after Bose? Oh, I just got that. Every observed subatomic particle is either a boson or fermion. Coined the term boson to classify the fundamental particles that obey Bose-Einstein statistics. Oh. Wow. I never knew that. I never knew bosons were named after Bose. Um, Calcutta. Kolkata. Kolkata. Oh, different Bose. Well, that makes sense. It's just a surname. Um, oh, so is this running Universe? Oh no, this is running the wrong thing. Let's run Universe Explorer again, because, yeah, I'm pretty sure the universe isn't going that far. So let's look. Import, just to make sure, pandas as PD. U is equal to pd.read feather. Let's read // data / universes /7 feather u u date max. Yeah, so January 30th. So let's go up to May 7th. Bose is a surname. It's a Bengali surname. Wait, it's doing the universe again? Why am I back to... It's not doing the universe. There we go. Okay, so Universe Explorer is now Going through May 7th, right? Saved? Yep. Tamil, where's Tamil? It says it's a language. Oh, I guess Tamil is a culture. So what do you think what do you think about the Aryan invasion theory that uh bunch of Aryans from the Caucasus invaded India and that's what brought the Hindu culture? I guess it's a theory. This is what my coworker was telling me. So have you heard of that? And what do you think of it? Okay, so now I have to get the universe. This is kind of boring. So let's see if I can get I want to create a model which uses the best parameters, not model, portfolio strategy. Both C.V. Raman and Srinivasa Ramanujan, isn't that the mathematician? Yep, that's him. They say he's the smartest guy ever. What's that story about him? He was like in a car with some guy, some other mathematician, and the guy says, well, what's crazy is there's no prime numbers, such and such. And he says, oh, I could think of a prime number that satisfies that. I want to create a portfolio strategy which uses the parameters from best practices for. All right, so let's look through all the things I want to vary. Where's this guy? Oh, I'm in the wrong repository here. CD stock market tool. I don't think that theory is true, though I don't think of it at all because I don't care if it's true or not. Well, fair enough. So what are I need Portfolio Explorer. All right, so I want to get the best parameters for HRP. No, HRP. Oh, Anaconda's like they call it a package management. Basically, in Python or any coding language, they have packages. And a package is just some code that somebody built that they open sourced. So packages have different versions. So when you're making a project, you get all sorts of you start using packages like numpy's a package, pandas is a package. Numpy's for doing fast efficient computations. Pandas is for doing fast efficient computations and organizing data. There's the plotting library, which is matplotlib. They have all these different libraries. And since it's just some code that somebody's written, they've put it out there, but there's always some improvements to be made. There's always some new features people want and stuff. And so they'll change the version. So you'll build up your code on one version, and then they'll update the package, and then it'll be a different version, and sometimes that breaks your code. So to make sure that Anaconda is like a common thing that people use to make sure their code doesn't break. So you can install certain versions of packages, and then when someone's downloading your code to use, you can just specify the versions, and it will install the correct versions. So you basically Anaconda is the thing that lets you make different environments, they call it, and each environment could have unique packages with unique versions. So each project really should have its own environment. So Anaconda just lets me manage this. I want to create a portfolio strategy which uses the parameters from best practices for HRP look back window. Okay, so prediction smoothing. It's the smallest number that can be expressed as the sum of two cubes in two different ways. Wait, what is? It's about 1729. He was in a. Oh wow, you know that story then. He was in a hospital and G.H. Hardy was visiting him. Hardy said it's a bad omen because the taxi number was 1729, which was a dull number. Ramanujan says no. It's the smallest number that can be expressed as a sum of two cubes in two different ways. Wow, that's crazy. What a unique brain that guy had. High powered brain. Why not do a grid search and find the best parameters for your strategy? So I've done that, but then so this is the pro. So if you look at the different methods I'm trying out, I am doing that. So some of these are optimized. I'm finding the best parameters using a Bayesian optimization. So I'm optimizing just for 2016, optimizing 2016 to 2022, optimizing during the whole time range, optimizing only for 2020. Because really, the problem I'm having with the portfolio strategy is that 2020 is the year it does poorly. I've got it now, so it does uh, really well, but it's still failing during at least part of 2020. So optimized to 2020. But then I also want to have these first principles models just to see how they do. It's kind of different. Like the problem with an optimization is you always have like that. It's optimized to your past training data. So I want optimizations, but I also want some first parameters models. And this is because, I've never paper traded a strategy before. I've never gone live with a strategy before. So I want to have as many strategies as possible for Monday morning when I start paper trading. If I run out of time, I will go ahead with only the optimized models. Probably if I run out of time, I'll use. Well, these models should be pretty easy to get, but the strategies, it'll take a while to optimize everything for a model. So if I run out of time, I'll just focus on 2016 to current optimization. Probably the first two, and then the bottom one. Um, but I want to try out a lot of different portfolio strategies, and yeah, I kind of want to go from first principles and see how that does. And also for a model that's trained all the way through the current time, um, probably I should just be using first principles on that. I don't have if it's trained up to the current time. Then I'm training on previous. Yeah, I don't know. You kind of you run into that problem with the training data. Prediction smoothing, buffer multiplier, sizing method, beta neutral or dollar neutral. Um, Sorry, these are all AI models. Like there isn't. Uh, I don't know. It depends what you call AI. It's machine learning. It's a light gradient boosting method. So if you've ever heard of a random forest, um, it's basically a forest of nodes that where you draw relations between them. You train it to draw relations on the training data to predict some target. A light gradient boosting method is basically that, but it's a lot more efficient, so it trains a lot faster. And it works really well on stock market data. So it's a light gradient boosting method, a tree based method. Um, and so there's this core prediction model. Let me show actually the PowerPoint real quick. So um, the workhorse of the strategy is the prediction model. I'm isolating a universe, then I'm feeding this universe and features into a model to predict returns. And then once you have a good model that predicts the returns, this is the real workhorse. This is what takes most of the time to create. This is what takes most of the research. But once you have a model that you're confident in returns, the final step is to implement some capital allocation strategy, a portfolio level model. But the portfolio model is very simple. It's really leaning on the returns model. Um, you know, here's the output. Here's the predicted returns for the day. Decide how to allocate capital, basically. Um, so yeah. Um, Now let's finish putting in everything that I want. Um, the scaling parameters are used to lower exposure during times when the model may lose money. To lower exposure to minimize drawdowns and volatility. Therefore, maximizing the Sharpe ratio. The scaling parameters are as follows. Target volatility, volatility look back, drawdown. Any fun stuff with Brownian motion? You mean use Brownian motion on a stock market model, or just generally fun stuff with Brownian motion? And no, I haven't. I'm not even sure how to incorporate. I mean, Brownian motion is that's like a physics thing. How do you incorporate that into a stock market model? Oh, so a random walk basically. Continuous, random, and independent. Target volatility, volatility look back, drawdown warning threshold, drawdown penalty, drawdown kill threshold. Okay, let's go. We should have the universe by now, so we can go back and. No, I haven't, but that'd be interesting. I have all sorts of things I need to do to improve this strategy, but one thing is looking at different sorts of models, different strategies for predicting. Um, all right, so explorers. Do we have the? All right, let's go back in here. Let's see. Do we have the universe? Okay, good. So it got data for May 1st. Now we can say, let's run the paper trading model script. All right, so that's going to run. Now let's finish putting in this prompt. Drawdown kill threshold. Um, okay, now I'm gonna go to the bathroom really quick. I'll be right back. Thanks for watching. Get out of here. Okay. Copy that. Actually, yeah, I'll just make a bunch of dictionaries. And let's see, did this run? Good. Whoa, that looks really bad. Uh-oh. Hey, thank you, Michael. So what is the information coefficient? Very low. Oh, yeah. But that does that, well, I have a Mac. If you have a Mac, you can do that Control, Command, Shift 4. And then it just goes to your clipboard and doesn't save.